So in the course of this presentation, I hope to introduce you or give you more information on a 50-year-old gold producer whose first asset was in Colombia and who acquired a second asset in Nicaragua. We have an extensive record of paying dividends, so we've been a dividend payer for in excess of 4 decades, with a couple of exceptions in the 90s when the price of gold was quite low. We think that given our land packages, we have extremely high probability of finding additional deposits in both of our jurisdictions. I'll walk through very briefly where we would see organic or inorganic opportunities to grow. We have a strong social license to operate, and I know that a lot of mining companies will say that, but over the next couple of minutes, I'm hoping to demonstrate that for you. And we have an experienced management team. So really quickly, before I dive into the assets, so in the first quarter, we had $160 million in revenues, $38 million in earnings. That translates into 13 cents a share. We have about 300 million shares outstanding. We have negative net free cash flow in the first quarter. Your first question will be, why in God's name would you have negative free cash flow in a quarter when you're making so much money? So the issue is, and once you start to look at the company, I'm hoping that you'll dig into our balance sheet and our P&L, but we had extremely high, we had about 42 million in accounts receivable at the end of the quarter. If you fast back 1 year, in the first quarter, it was negative 1.9 million. So if you take the last 12 months, you've got about 87 million in net free cash flow. The other thing that acts on the first half of the year is a lot of our taxes are due and payable, so that cash goes out the door in the first quarter to the first half. The first quarter sales of gold were done at $28.81 on average, and these numbers that I'm producing for you, the average price of gold that we sold last year was $23.87. So just remember that we're in a bit of a higher gold price environment currently. So you should be concerned about what our balance sheet looks like. We've got about 81 million in cash on the balance sheet. We've got about $28 million in debt sitting in Colombia. It is denominated in Colombian pesos. A lot of people have asked us why we haven't paid that off, given the fact that there's an awful lot of cash lying around and Colombian debt tends to be a little bit more expensive. This debt was acquired when we refurbished our hydroelectric facilities, and I'll dig into that a little bit more when I discuss the assets. But it's tax effective to just leave it there. So in the first quarter, we had 71 million in EBITDA, and in the trailing 12 months, 240 million in EBITDA. I'm going to stop there just for a quick second. Closing price for our shares was $2.40, I think a couple days ago. So the issue is our stock trades in Canadian dollars, and our financials are reported in US dollars. So all of these numbers I've just talked to you about are in US dollars. So when you look at your screens with the company, it'll show our dividend yield being something like, it'll show some odd number. It's because Bloomberg and the rest of these terminals don't understand that they have to convert the Canadian dollar share price to a US dollar equivalent, because we pay, or we will pay this year, 10 cents in dividends. So I mentioned briefly that this is a long-term dividend payer. It's been paying dividends for more than 4 decades. What's really interesting about this slide is that we acquired the Hemco property in 2013, and at no point have we discontinued the dividends. We are prepared to lower them from time to time if we see an alternate source to pay out our cash, but we paid 10 cents last year, and we're going to pay 10 cents in this coming year. So 2 assets, one in Colombia, one in Nicaragua. I'll start in Colombia, or I'll start just to show you what the assets did in the first quarter. So Colombia produced about 23,000 ounces of gold, and it did so at an all-in sustaining cost of about $12.95. I've put the 23,000 ounces of gold against what we expect to produce in this year. So we guided to 81,000 and 91,000 ounces, and we guided to a little bit higher sustaining costs. So your first question would be, how come you're below the bottom end of your guidance? Largely because we produced more ounces in the first quarter than we expected we would, and because the Colombian peso was a little bit weaker. Turning to Nicaragua, we produced just under 31,000 ounces, and we did so at all-in sustaining costs of $18.55. So you're also going to note that we're on track on the production because we expect to produce somewhere between 120 and 132,000 ounces, but we're above the high end on all-in sustaining costs. So your next question, very rightfully, should be why. In Nicaragua, about 70 to 75% of our production comes from toll milling rock that we buy from artisanal miners. We pay those artisanal miners 40 to 45% of the spot price. Accordingly, our cost for that rock is indexed to the price of gold. So in a high and rising gold price, our costs will go up for that percentage of our production. So, Nichi. Nichi is an ancient alluvial plain about 190 kilometers north of Medellin. If you ever end up at our mine site, you will have taken about a 30-minute plane ride from Medellin to El Bagre. There we have identified 1.35 million ounces of gold in the proven and probable category, and we have another 1 million ounces in the measured and indicated category. This operation has actually been in operation for more than 100 years. It's been in our hands for 50, and there's been just around 9 million ounces taken out of the deposit, 3.2 million with us. So what we do in this situation is you've got this gold has washed out of the Andes over time, over millennia, and it's sitting in this flat-lying alluvial plain. So what we do is we go into our new areas and we will take samples of trees, plants, matters, and we will put those aside in a nursery. We'll take down the trees. Any animals that haven't moved along on their own, we scoop up and we put them in our wildlife preserve for our vet techs and our veterinaries to take a look at. And then we take off that first 10 to 12 meters of barren sand, gravelly muck. And then we will mine the next 12 to 30 meters with 5 big bucket dredges. And these bucket dredges are about 7 stories high. They've been retrofitted with satellite uplinks and GPS, so we know exactly where we are in the deposit as we're moving these big dredges. And then we have a number of smaller dredges that work in these closed ponds with us. So, important point, we create closed ponds beside the Nichi River so that we're not affecting the river. So again, if you ever accepted an invitation to come and visit the site, we would take you downriver about an hour and a half. Then we would get you out of one boat, we'd walk across an isthmus, and we'd get you into a new boat to take you to one of the dredges. On board one of the dredges, you will see gravity separation, water and gravity separation. And on the dredges, we refine that into a rich sand, which we put in canisters, and then we fly off the top of the dredge to go back to El Bagre to be refined. Once we're done with that, what we do is we take that overburden that we had set aside and we bring it back, recontour the land. We create farmlands, wetlands, we've got rubber plantations, we've got cocoa farms, and we've got beekeeping. One of the things that Mineros understands in spades is that mining is a kind of a one-direction industry. And so what we're trying to do is develop those businesses that are sustainable and that make us part of a responsible partnership so that there are businesses left behind once we're gone. The other thing that's really important is water and gravity. No cyanide, no mercury. This is free gold that is just washed out of the Andes over millennia. Turning to Nicaragua. So we acquired this asset in 2013, And at the time, we were producing about 65,000 ounces of gold. And this is 2 underground mines and an artisanal mining component. So what we've done over the last 12 years is we've developed a sampling plant that's entirely hands-on, so the artisanal mining partners who are working with us can be confident that we're not doing anything to the rock or affecting it in any way when we take the samples. We embed fiscals or auditors into the process so they can be confident that we're good partners to deal with. Additionally, what we do is we've embedded an auditor into our lab so that they can also see that we haven't affected the lab samples that they're working with. So the artisanal miners will bring us 10 to 12 ton material, and then what happens is that gets sampled, and then we offer them what we think the contained gold is based on the assay, and they will either leave it with us or take it away. And the only reason why they've ever taken it away really is because we have a 3 gram cutoff. So we think that we get the material, all of the material eventually, but it's usually because they go and mix it with other material. So organic growth. One of the most important things to discuss is Nicaragua. We have this 165,000 hectare land package, and we're blessed to have a new CEO on board. David is here with me today. We are operating out of the Panama and Pioneer mines, and they're in a 4-kilometer strike. We have discovered another deposit. And so David's first question when he was onboarding with the team in Nicaragua was, what have you done to discern what's going on between Panama in the northeast and Pioneer in the middle and Porvenir, which is in the southwest? And so I fully expect that we're going to be doing more drilling there in short order. Plus, I fully expect that we're going to be doing some mag surveys. Porvenir, there was a PFS done on Porvenir a number of years ago, and you'll note that most PFSs are done at 5% discount rate. This one was at 10, and it still stands that we've used $1,500 an ounce gold. So one of the things that we're doing here is we really want to understand the metallurgy before we go and build a plant. This deposit's a little bit different from Panama and Pioneer. It's got a bit of zinc in it. And for any of you who have been zinc bugs at any point in time in your life, which I think there are very few in the room, but I worked in zinc for 16 years, is we know that we have to get differential separation. We know that we can't have any of the gold or very, very little gold reporting to the zinc concentrate. So we really want to understand the metallurgy in order to understand the flow sheet. The other thing that's super important, and David brings this new eye to our operations, in that he came out of AngloGold Ashanti and Barrick, Detour, and most recently OceanaGold. He's got deep experience with both underground mines and open pits. And so his first question was, why 2,000 tons a day? What happens if we find another big deposit there? You know, what would be the optimal size for this plant? You know, should it be built so that we can expand it at a later time? So those are all questions that we're asking, and rightly so. So just to finish up, organic growth. So like many producing mining companies, we're looking for additional assets to add to our stable of assets. We're typically looking anywhere from Alaska to Patagonia, kind of in that 3-hour time zone, looking for something that's 50 to 100,000 ounces, and looking for something that's not going to break the bank. As mining investors, you're used to people buying things with big build capex and not necessarily hitting their numbers, which can be devastating for shareholders. So we're really focused on being very logical and methodical in our acquisitions. So with that, I think I'm done.